If you're in Summerlin, behind on your mortgage, and scared to even check the mailbox, you are not alone. But here's the part most people don't know. You still have options. 8 good ones, in fact, and selling is only one of them. And if you act fast, you can avoid foreclosure, protect your credit, and move forward with your life. Option 1, sell before foreclosure. Pre-foreclosure sale. This is your cleanest exit. If your mortgage is too much to handle and foreclosure is on the horizon, selling the home before the bank takes it can save your credit, your sanity, and sometimes even your savings. In Nevada, foreclosure can move fast, just 6 months from your first missed payment. But during that time, you still own the home, and that means you can sell it. If your home is worth more than what you owe, you list it, sell it, pay off the loan, and walk away with no foreclosure on your credit, and maybe even some cash in hand. Even if you're already behind, lenders often pause foreclosure once they see the home is listed. Don't have equity? You might still qualify for a short sale, selling for less than what you owe with the lender's approval. It hurts your credit, yes, but nowhere near as much as a completed foreclosure. And Summerlin's market, most homes sell within 30 to 90 days. With the right agent and pricing, there's still time to move fast and avoid disaster. If you choose to sell, don't wait too long to get started. Time isn't on your side in this instance. And if you need a referral to an agent, please let me know. I've got some good ones in my phone. Option 2, loan reinstatement. If your hardship was temporary and you've now got access to funds, a bonus, tax return, or family support, you can reinstate the loan. That means catching up all missed payments, late fees, and penalties in one lump sum. Once you do, the foreclosure is stopped and your mortgage is back in good standing. Ask your lender for a reinstatement quote. This is often the fastest way to stay in your home if you can afford it. Option 3, loan modification. Maybe you can't pay a lump sum, but you do have steady income now. A loan modification could be your path forward. This involves working with your lender to change the loan terms, lowering your monthly payment by extending the loan term, adjusting the rate, or adding missed payments to the balance. If your home is your primary residence, Nevada's Foreclosure Mediation Program lets you legally request mediation with the lender before foreclosure moves forward. If the mod is approved, your loan becomes current under new terms, you avoid foreclosure, stay in your home, and rebuild from there. Option 4, refinance. This one is trickier, but if you've still got decent credit and equity, refinancing into a new loan can stop foreclosure. You pay off the old loan entirely and start fresh. Some people turn to hard money lenders in a crunch. Just be cautious. These loans are expensive and short term. Only refinance if you're confident the new payment is sustainable or you have an exit plan, like selling down the road. Option 5, forbearance. Facing a temporary setback, a forbearance could buy you some time. It's a short-term agreement where the lender reduces or pauses your mortgage payments. Foreclosure is pause while it's active, but here's the catch. You'll need to repay what you missed, often through a lump sum or repayment plan. It's a bridge, not a long-term fix. But if you're about to get back on your feet, it might be all you need. Option 6, repayment plan. Instead of catching up all at once, a repayment plan lets you make up missed payments gradually. You'll pay your regular mortgage plus an extra amount each month until you're caught up. This only works if your budget can handle the higher monthly total. It's often paired with a forbearance. First, you pause payments, then you repay them over time. Option 7, deed in lieu of foreclosure. If selling didn't work and you can't stay in the home, you might offer the house back to the lender voluntarily. You hand over the title, and in exchange, the bank cancels the debt. It still impacts your credit, but less than a foreclosure, and it gives you a cleaner, more private exit. Always make sure the lender agrees in writing to forgive any remaining balance. Option 8, bankruptcy. This is the last resort button, but it does work. Bankruptcy puts an immediate legal stop to foreclosure through what's called an automatic stay. In Chapter 13, you repay your mortgage arrears over time, usually 3 to 5 years, and keep the home. In Chapter 7, you may erase the mortgage debt, but likely won't keep the home unless you can also catch up quickly. If you're juggling multiple debts and need to stop everything at once, it may be the right path. Always speak with a bankruptcy attorney first. Now, owner-occupied versus investment properties. If you live in the home, you have more protection, like access to Nevada's mediation program, and in many cases, protection from deficiency judgments after foreclosure. If it's an investment property, lenders are typically more stringent. You may not qualify for modifications, and tax on forgiven debt can be higher. If you're a landlord, you'll need to act even faster. The prospect of a foreclosure can feel overwhelming. But in most cases, it's avoidable. If you act early, you can save your credit, your options, and maybe even your home. Whether that means selling now, modifying your loan, or negotiating a plan with your lender, the key is to move quickly. And if you're not sure where to start, just reach out. No pressure. This is what I do, and I'm happy to walk you through your options. Either way, I hope this gave you a little more clarity and a little less fear.